The biggest change in the oil market over the last decade has been the rise in America's production. This production increase has turned the U.S. into the largest oil producer. $50 per barrel of oil price is required to make the America's oil production up and running. The growth in U.S. production was induced by prices above $100 per barrel, at which shale oil production became viable. The oil war and recent fall in oil prices jeopardizes this production. In other words, a large part of U.S. oil capacity is likely to be put out of business by the price war. The United States consumes about 20 million barrels of oil per day. The fall in prices from around $50 per barrel to $30 per barrel would reduce this expenditure by about $150 billion United States dollars. At the new price, however, the domestic oil industry will suffer severe cutbacks in production, employment, investment, and the death of the shale oil industry in United States of America. The new global price is clearly aimed at bringing this capacity destruction about in the U.S., and once it has happened, the oil price will no doubt rise again towards the previous level. Moreover, since reduced oil consumption is a goal of the green agenda, if the lower price induces a rise in demand, that could be viewed as a negative, not a source of economic welfare gain. Furthermore, the potential end game of the oil war envisioned by OPEC is one where marginal producers such as the U.S. have to eliminate maybe 3 to 4 barrels per day of production, leaving the market in equilibrium at around $60 per barrel, a price high enough for OPEC to be highly profitable but low enough not to entice the re-emergence of more marginal U.S. production.